Well, thank you, Dave, for inviting me to speak here. I'm having a severe allergy situation today. It's allergy season here in California, but I appreciate you giving me the opportunity to speak. I made my first trade in the summer of 1967, so I've been around for a while. And I've got even better news for you. I have nothing to sell you today, nothing. So it won't cost you anything to listen to me. I want to talk to you a little bit about the trading model, some trading issues, a little bit about seasonality, a couple of concepts, a little bit about indicators, and most of all, I want to give you a demo of artificial intelligence the easy way can be used by traders. It's absolutely tremendous how much time it can save you. So we'll begin with the usual disclaimer, which basically says, if you don't already know it, that you can lose money trading. In addition to that, I want to talk to you about the pillars of success. So there are a number of things that are necessary in order to be successful in trading. And believe me, I've been trading for 52 years. I know what I'm talking about. First, you need a methodology. The methodology has to be crystal clear. It has to be based on rules, and the rules have to be not subject to any interpretation. So that 2 people, 10 people, 100 people, all looking at the same information will reach the same conclusion every time. If that's not happening, you don't have a methodology. Next, you need a philosophy. Why are you trading? Are you doing it for some humanitarian reason? Are you doing it for some personal reason like wealth? Be clear on what your philosophy is of trading. It doesn't matter what it is. There is no correct or incorrect philosophy, but you need to know why you're doing it. Psychology, of course, one of the most important things because, as Steve Primo said just before, he did a great job, by the way, you need a specific psychological orientation because even though the methods you're using may work in back testing, it's only you who can screw them up when they're supposed to be working. It's all about psychology. And of course, people will lecture you on discipline. They'll say you need to have discipline in order to learn how to trade. Well, discipline is important, but what's more important is confidence. If you don't have confidence in the methodology that you're using, you won't have discipline. If you don't have discipline, you won't have confidence. If you don't have confidence, you won't make the trades you're supposed to make, which means you will lose discipline and get worse and worse from there. So before you do anything, make sure the strategy that you're working is clear and rules-based and not subject to interpretation, which will give you confidence, which will give you discipline, which will give you profits, which will give you more discipline, which will give you more confidence, blah, blah, blah. Next, you need the right technology. If you want to trade from your cell phone and it will do everything you need, fantastic. But if you don't have the right technology, it's not going to work for you. If you need a fast computer, you better get one. You've got to have the right equipment. You need structure. You need a trading model, such as the one I'm going to show. If you don't have a trading model or a trading structure, it's never going to work for you. And the money that you make will be made out of sheer dumb luck, which is not a good way to make money because luck doesn't last. You need reality, by which I mean you need to know that you can actually do what you're trying to do. Example, I have many mentoring students over the years, and many of them are doctors. They want to be able to day trade while they're being surgeons. In fact, I even had one doctor who said he likes to day trade while he's doing operations on patients. Not only unethical, but unacceptable. So you need to know what you can really do. If you want to be a day trader, do you really have the time to be a day trader? Or is it unrealistic? And in order for that to happen, you need to be honest with yourself. Look in the mirror and say, I'm a bad trader. I'm a good trader. I'm a strong trader. I'm a weak trader. I'm a short-term trader. I'm not an investor. Whatever it is, be honest with yourself because it all begins at that point. So the pillars of success are extremely important, and keep a copy of that handy and be honest with yourself. What works for me? I have developed a number of methods that work extremely well for me and have done so through the years. I will show 2 of them today. Of these methods that I use, I will show you today seasonals and divergence, and I will actually try and teach you something totally mechanical. Then I'm going to give you a demo of artificial intelligence, and one way in which the trader can use it very successfully. Here's my trading model. Setup. The trading model has three parts to it. The first part is the setup. The setup is a pattern. If you're a trader, you know, especially if you're a technical trader, you know that there are literally thousands of patterns. Head and shoulders, flags, pennants, reversals, key reversals, support, resistance, islands, etc., etc., etc. These patterns are very plentiful. That's the good news. The bad news is most of them don't work. We know they don't work. Easy. You put them on the computer and you test them. That's what computers are for. And you will find that the vast majority of patterns have zero predictive validity. They can't predict anything. So you need to find setups that work. And I would say 95% of the setups that people use don't work, never worked, and never will work. After a setup, you need a trigger. A trigger is what we call timing. Example, let's say you're looking at a key reversal. You know that by itself, the key reversal has no predictive validity. But if you add one element to it, and that element is there with the setup, that gives you a trigger. And that trigger will let you know it's okay to make the trade. Once you've made the trade, you need follow-through. Follow-through consists of four parts. Part number one, first profit target. As soon as that first profit target is hit, you are out of danger. Point number two, stop loss. Where are you wrong? Number three, follow through. Let's assume you don't get stopped out. Let's assume that you continue and reach your targets. What happens after that? You want to maximize your profit. It's a profit maximizing strategy. That's where most of the money is made. You may already believe this or you may not, but eventually you will. 80% of your money is going to be made on 20% of your trades. Most of your trades will be a little bit of a profit, a little bit of a loss, a little bit of a profit, a little bit of a loss. They'll balance each other out. But in the long run, your big money is going to be made on your big trades. And your big trades are going to be the ones that you keep for the longest with the follow-through strategy. Super, super important. I'm going to demonstrate some of that to you today. What's next? I'm going to show you something very interesting. Completely, totally cookbook method. So look at this chart. This is a chart of Bitcoin futures. At the bottom of the chart, we have an indicator, momentum 28 of the close. It's not a fancy secret indicator, no secret sauce here. Momentum 28 of the close is available on practically any trading platform. Sometimes it's called rate of change, sometimes it's called momentum, but in any event, it's ultimately simple. It is not a moving average, it's very, very easy. Just take a look at your platform and see if you have access. If it's called rate of change or if it's called momentum, we're looking at the same thing. And this is a 28 period, or 28 days, 28 hours, 28 minutes, whatever, of the momentum. 28 of the close. I'm going to give you a cookbook. Cookbook method number one. Find the lowest intra-bar low on the chart. Or in other words, that would be right over here. If you're not sure, look at your data and see if it is. I can assure you that was the lowest price on the chart. I'm going to put a little line there to demonstrate that, to indicate that for me. Very simple. Let's look at the chart together. Would you agree? This is the lowest price on the chart, but it is not the lowest momentum. That's perfectly clear and completely correct. Something we can all agree on. At this point in time, we had bullish divergence. Price making a new low, but the indicator not making a new low. So the next step in this cookbook process is to find the lowest momentum within the last 60 bars to the left of this point. That would be right over here. So I'm going to put a little mark there. And here we have the paradigm or the model for bullish divergence setup. Let's call these points A, B, C, and D, like so. A, B is in Bravo, C is in Charlie, D as in Delta, right over there. The paradigm will always be the same. A is lower than D, while B is higher than C. A is lower than D, while B is higher than C. Very simple. If you follow the rules, you will reach the same conclusion as I do every single time. So this is our setup. As I said in the model a few minutes ago, every setup needs a trigger. The trigger is the highest momentum between points A and, between points B and C inclusive, which means this point right over here. So I'm going to take a little line and I'm going to draw a little line over there because that is an exact number. And the line shows the number. Going forward, after point B, which is again, to remind you, right over here, anytime any bar closes, repeat, closes above this point, we get a buy trigger. Remember, it's not what occurs during the bar, it's at the end of the bar. And the trigger is not based on price, it's based on momentum. And that trigger would be right over here. And I'm going to put that on the screen with a little line, like so. It's a completely mechanical cookbook procedure within the context of what I showed you before. Setup, trigger, follow through. We have satisfied two conditions. We saw the setup, completely mechanical. We saw the trigger, completely mechanical. And now we need follow through. Follow through is very simple. We measure the range between the highest high and the lowest low during the period of divergence, like this. That entire range becomes our stop loss and our full profit target. 50% of that range becomes our first target. One moment, please. Let me just make one adjustment on my screen. Here we go. 50% of that range becomes the first profit target. The entire range becomes the full profit target. Let me show you what that looks like. One moment, please. Here we go. Target 1 and target 2. At target 1, we're out of the danger zone. At target 2, everything after that becomes gravy. At the end of target number 2, having been hit, you see what happens. We go down a little bit, then we come back up and continue higher for a long, long, long move. And this is where our trailing stop comes into play. In other words, our profit maximizing strategy. Very simple, piece of cake. A great methodology that is easy to learn, easy to use, easy to understand. Let me show you another one. Here's a chart, and these are all current charts. SIL, Silver Miners ETF. Again, the procedure, and by the way, the procedure for a sell is the opposite for a short sale. Right now, we're working with the buy procedure. Again, it's a cookbook. Find the lowest intraday low on the chart in the last 60 bars. So we're going back and looking at a window of 60 bars. Moment, please. 60 bars. So here we go. Let's mark this guy right over here, like so. And we go to the left and find the lowest momentum previous, right over here. And again, it's as easy as A, B, C, D. Bullish divergence, new low in price without a new low in momentum. Next step, find the highest momentum between points B and C inclusive, which would be right over here. And ladies and gentlemen, if you're not sure, look at the data. The data doesn't lie. Every trading platform has a data window. Open your data window and find that point if you're not sure. And that point would be right over here. And we're going to put a little line there, piece of cake. And at the same time, we're going to calculate our profit target and our stop. Highest high to the lowest low during the period of divergence, $285 or $2.85 a share. And the trigger occurs right over here on this day. So 2 days after the low, not bad, pretty darn good timing. Next step, first target, half of 285, full target, all of 285. So it's about $142 for the first target. So let's go to the next slide, see what happened. Not only did we reach our first target, but we exceeded it. And that is as of a couple of days ago. And here it is as of yesterday. And here it is as of, well, let's see, it is as of yesterday. As of yesterday, we had achieved most of the profit target, had taken part of the position off the table, half of this range, and placed the stop at break even. Now, what's really interesting is this. Momentum is not the only way to measure divergence. We can also measure divergence with another indicator called the detrended oscillator. So I've done the same work, but using the detrended oscillator. Take the lowest low in the chart, A, B, find the lowest detrended oscillator on the chart right over here. And if you compare this number with this number here, you'll find this number was actually lower. So don't rely on your eyeballs, rely on the numbers. So this is the divergence pattern right over here. This is the highest point between the two, triggered right over here 1 day after the bottom. The profit target was $169, and you can see it achieved the profit target well over 169. So that is the divergence methodology. Let's look at it on another chart. Here's another one. Oh, and this is the trailing stop procedure. Let's do this. Let's do something different for a moment. Let's look at seasonality. Divergence is a very simple indicator. You can learn about it in some of my books. You can go to my website. There's a course on divergence there if you're interested. But let's talk about something different. Let's talk about seasonality, my next best method. Seasonality being the tendency for prices to repeat at certain times of the year in certain directions. One of the best books ever written about seasonality was written by a guy named Art Merrill, M-E-R-R-I-L-L. It's entitled The Behavior of Prices on Wall Street. Art proves statistically that, excuse me, the day before major U.S. legal holidays, the stock market tends to close higher. So, for example, Thanksgiving Day in the United States is always on a Thursday, the last Thursday of the month of November. The market is closed on that day. It is open on Wednesday and it is open on Tuesday. So the rule that Art Merrill proposed was buy the close of trading on Tuesday, get out of the close of trading on Wednesday. He demonstrated statistically that over 70% of the time, all the way back to the late 1800s, that relationship was correct. A very short-term trade. And even though the rules are completely simple and totally objective, people still find a way to screw it up. So as Steve Primo said just before, it's entirely up to you. We can show you good methods, but if you don't use them, it's going to be the weakest link in the chain. So at the free website that I gave you, my website, giving you free trial subscription, you will find the ability to study seasonality in its other forms on a longer term basis. So for example, here is a trade that we recently found on the website in S&P futures. The computer was asked, show me trades for the month of March that have been right 75% of the time or more for the last 35 years. Very ambitious request. The computer came back and said, here are the trades for the month of March. Bought S&P June contract, end of day, the 11th of March, and got out the 2nd of April with a 4% risk close only, your accuracy would be 76.9%. This would be your average profit. This would be your average loss, and all the other statistics that you want to know in making a trade. This is the trade that we're in right now, buying on the 11th, looking to get out on the 2nd of April or the 1st of April, or at the profit target right over here. So take a look at these numbers. Here is a chart of the S&P showing the entry date for this trade right over here. The very next day, it achieved a gain of 56 points. Remember that 56. Look right over here. And this data here did not include the year 2024. It was only current to the year 2023. Pretty amazing. It knew it in advance. It's not perfect, but it does give you a clue as to the most significant, most reliable, highest probability seasonal trades in any of the stock or futures markets that are available on the website. So we've got about all of the major US futures there. We have many important stocks. The stocks that appear at Seasonal Trader, where you get that free trial, are those that were selected as having the highest seasonal behavior. And you'll notice there's even a trade right over here, March 22nd through April the 4th, with almost 81% accuracy. I want to stress, no guarantee. This is all based on history, so call it hypothetical. I gave you the hypothetical disclaimer earlier in this session today, so bear that in mind. I've also run a trade here for you for the month of June. Right over here, I'm sorry, where is it? Right over here for the month of April, sorry about that. So we have trades coming up with high probability, and you'll notice that most of these trades, excuse me, are approaching 80% probability or even higher. For example, April 13th through April 19th, very short-term trade with high probability. So we have everything, the stop, close only, the PL ratio, the average profit, average loss, all of the statistics that you want to know. And let me tell you one more thing. Don't trade without the numbers. If you don't know the numbers of what you're doing, it's going to cost you. There are many trading strategies around. If you go to the internet and you punch in the search term, teach me how to day trade or teach me how to trade, you will get literally over millions, probably 1 billion hits. Everyone wants to teach you how to trade and charge you money for it. It's not complicated. You can find out on your own. But here I want to demonstrate something to you. I hope this works. We're going to change subject to artificial intelligence. Available to you free of charge at this point in time through ChatGPT-4 is a very incredible search engine that will find information for you and digest it for you and give it to you all on your phone, and it won't cost you a penny. There are advanced versions to the $20 version, the $90 a month version, and so forth. But I want to demonstrate something to you, and I hope that it works. So let me come back to, one moment, please. I'm going to go to, oh yeah, on this. You will need this to help you find trades at seasonaltrader.com. But meantime, I'm going to do this. I'm going to ask ChatGPT a question and play you the answer as soon as I get the question asked. So I'm going to my phone, my cell phone right now. I'm opening ChatGPT-4. Just bear with me. Here we go. And I'm going to ask Chat a question. Example, I'm going to ask about the Elliott wave theory. And here's the question I'm going to ask, and then you're going to hear the answer momentarily. What is the Elliott wave theory, and is there statistical evidence that it has predictive value?
The Elliott wave theory, named after Ralph Nelson Elliott, is a fascinating concept that attempts to predict market movements by identifying repetitive patterns of waves. Let's dive into the details. Origins and concepts. Inspired by the Dow theory and observations from nature, Elliott proposed that stock market movements follow a predictable pattern of waves. He believed that these waves influenced not only the stock market but also other aspects of human activity. Elliott's ideas gained attention through articles published in Financial World magazine in 1939. His work was further developed by Hamilton Bolton in the 1950s and 1960s. Basic principles. The Elliott wave theory consists of a series of waves. Impulse waves 1, 3, 5. These are upward moving waves that follow the main trend. Corrective waves 2, for these are downward moving waves that correct the trend. Waves A, B, and C, these correct the main trend established by waves 1 through 5. The entire pattern is made up of 8 waves, 1, 2, 3, 4, 5, A, B, and C. Each wave within a count contains a complete 5 to 3 wave count of a smaller cycle. The longest wave count is called the grand supercycle, which breaks down into supercycles, cycles, and smaller subdivisions. Fibonacci numbers and time span. Fibonacci numbers play a crucial role in Elliott wave theory. The sequence starts with 1 and adds the previous number to arrive at the new number, e.g. 0 plus 1 is equal to 1, 1 plus 1 is equal to 2, 2 plus 1 is equal to 3, 3 plus 2 is equal to 5, and so on.
Just keep listening,
Elliott
folks.
defines cycles that fall within the Fibonacci sequence, e.g. 2, 8, 34. Practitioners use wave counts and Fibonacci numbers to predict market moves across various time spans,
The
from
most
minutes to
important part is
decades.
the very end,
Predictive value and subjectivity.
right here.
The Elliott wave theory is a probabilistic approach. It provides some predictive power, but no guarantees. Its accuracy depends on an accurate wave count, which can be subjective. Determining where one wave starts and another ends can be challenging. Analysts often combine Elliott wave analysis with other indicators for more confidence in their predictions. In summary, while the Elliott wave theory offers intriguing insights, it's essential to approach it with a healthy dose of skepticism and complement it with other tools for robust market analysis.
So, folks, 2 things. Number 1, you just learned a lot that you might not have known. Number 2, maybe you learned too much. Number 3, the most important thing, it's subjective. Compare that subjectivity and the rigmarole that you just heard with these specific indicators that I just gave you in a very simple demonstration of the seasonals and the divergence methodology. Incredibly simple. So that's what you're looking for. Now, since you enjoyed that so much, I'm going to ask ChatGPT one more question. So just hang in there for a moment. Here's the question. The 50-day moving average and the 200-day moving average are used by many traders as the golden cross and the death cross. Do they have accuracy? Are they predictive? Do they have predictive validity, and are they statistically profitable?
Certainly. Let's delve into the 50-day moving average 50 DMA and the 200-day moving average 200 DMA, their significance, and whether they hold predictive value or profitability. 50-day moving average 50 DMA. The 50 DMA is a widely respected technical indicator used by traders and investors. Trend indicator, it works well as a trend indicator. When the price remains above the 50 DMA, it's generally considered bullish, below it, bearish. Reliability, the smoother nature of the 50 DMA results in fewer trading signals compared to shorter-term moving averages. Golden cross, when the shorter-term moving average, e.g. 50 DMA, crosses above the longer-term moving average, e.g. 200 DMA, it's called a golden cross. It often signals a potential bullish trend reversal. Death cross, conversely, when the 50 DMA crosses below the 200 DMA, it's known as a death cross, indicating a potential bearish trend reversal. Profit targets. Traders often close trades based on the direction of the 50 DMA, opposite to their trade direction. 200-day moving average, 200 DMA. The 200 DMA is a longer-term moving average. Market sentiment. It reflects the overall health of the market. Stocks above the 200 DMA are considered healthier. Predictive validity. While it doesn't predict precise market movements, it provides context and helps identify trends. Reality check. When a position hits the 200 DMA after a rally or sell-off, it acts as a reality check. Timeframes. Works well on weekly and monthly charts, pinpointing turning points in corrections and long-term trends. Profitability and predictive accuracy. Moving averages are lagging indicators, meaning they react to past price data. Their accuracy depends on the context, market conditions, and other factors. No guarantee, while they offer insights, they don't guarantee profitability. Combined with other tools, traders often use moving averages alongside other indicators for more robust analysis. In summary, both the 50 DMA and 200 DMA play essential roles in technical analysis, but they should be used in conjunction with other tools.
So there you have it, the 50 and the 200 day. I wanted to do that for you so that you can see that you can use your Chat GPT, the free version as well, GPT-4, to do a lot of research on very specific subjects. But remember, the answers you get will depend on the questions you ask. You must ask the right questions specifically and clearly, or you're going to get a bunch of gobbledygook and sometimes what they call hallucinations by ChatGPT will give you answers that are totally off the wall. I hope you've enjoyed learning a little bit from me today. Seasonaltrader.com free trial is available to you. I have nothing to sell you except some ideas. Dave, thank you so much for having me here. I appreciate it.